Hello, in this video, I'll be discussing impairments, which is the first part of property, plant, and equipment, finite life intangible assets, and indefinite intangible assets that are not goodwill. Let's discuss an impairment. What is an impairment of value? So when we capitalize the cost of the asset, a fixed asset, property, plant, and equipment, or an intangible asset, the assumption is that there is no significant reduction in the anticipated total benefits or service potential of the assets. So when we capitalize it, meaning we put it on as a long-term asset on our balance sheet, we assume that the benefit from the asset is not going to be reduced. However, situations can arise that can cause a decline in the benefit of that asset, and then we have to measure an impairment loss. So basically we have to write it down and for its new fair value, which is lower than the book value that the asset is currently sitting on the balance sheet as. And the way we decide whether an impairment loss exists and how much it is will depend on whether an asset is considered to be held and used, or if the asset is being held for sale. This video is going to be focused on assets to be held and used, which is basically assets that we use in the day-to-day operations. Note, once an impairment loss is recorded, even if the value of that asset is deemed to increase afterwards, you cannot recover that impairment loss. You cannot reverse it. So an impairment loss is a permanent reduction in the asset. There are different guidelines that are used to decide, is there an impairment loss and how much should the impairment loss be for? And they're separated between property, plant, and equipment, and intangible assets with finite useful lives. Intangible assets with finite useful lives, some examples are patent or a copyright. And these will be assets that are subject to depreciation, depletion, or amortization. And you have to look at intangible assets with indefinite useful lives. And those can be Goodwill or trademarks or trade names are just some examples. And those assets are not subject to amortization. We don't take our annual amortization expense for those assets. Okay, according to GAAP, the assets that we determine if we look at them to see if they are impaired are grouped at the lowest level for which identifiable cash flows are largely independent of the cash flows of other assets. In other words, the assets are grouped together only when they're dependent on one another. To the extent that an asset is not dependent on one another, each asset is separately analyzed to see if an impairment has occurred. And this is, there's a lot of judgment in grouping assets, whether an asset should be and should not be grouped. And when do we test for impairment this is for property, plant, equipment, and finite life intangibles. And we test for impairments only if events or changes in circumstance indicate that the book value of the asset or asset group may not be recoverable. So it has to be something that triggered an analysis to see if an impairment might occur. And what are those some examples? If there's a significant decrease in market price, a significant adverse change in how the asset is being used, or maybe its physical condition has completely deteriorated, if there's a significant adverse change in legal factors or the business climate, if we incur more costs than we expected to buy the asset or the construction of an asset, or if the asset is generating a history of losses, or they're projecting to continue losses, then maybe the asset book value should be written down. Or if we realize that the asset will actually be disposed or significantly reduced in use before the end of its estimated useful life. Those are all potential events that could trigger an analysis to see if an impairment is warranted. So let's just say one of those events is triggered and a company decides, let's see if we have an impairment issue. And impairment loss is a two-step process. The first step is called the recoverability test. And this is to determine, is the asset impaired? It is not to determine how much the impairment is. This is just, is it impaired, yes or no? And the way we do that is if an impairment occurs when the undiscounted sum of estimated future cash flows from an asset is less than the book value. So I've highlighted this undiscounted word in red and bolded in red because it's very important. So this is the undiscounted future cash flows. If those are less than the book value of the asset, right? If that's a check, then do we have an asset that's impaired? Yes, we do. If the answer is no, you can just stop right there. But and we're going to be told this in the problems. If it's a yes, we go to step 2, which is to calculate how much should the impairment be recorded for. And an impairment is recorded for the amount for which the asset's fair value is less than the book value. So fair value is less than the book value, and the difference between those will be the loss. Okay? And the fair value is really the amount which the asset could be bought or sold in a transaction between willing parties. How do we determine what the fair value is? It could be a quarter market price if that's available, or it could also be the present value of expected future net cash flows, which is also the same thing as discounted future net cash flows. So that's why I've put this in all caps. So back to the recoverability, you have to look at the undiscounted sum of estimated future cash flows to see if the impairment exists. When you're calculating how much the impairment should be, you're going to look at the discounted future cash flows. So just be careful between the different pieces of information that a problem presents. Or it could also be called the present value of the expected future net cash flow. These are all what can constitute fair value. And if fair value is not determinable, then it can be estimated. And this is once an asset is written down for an impairment, then that new written down book value becomes a new cost basis, and then the company has to recalculate how much depreciation and amortization they can take based on that new cost basis. Let's go into an example. The Dakota Corporation operates several factories that manufacture medical equipment. Near the end of the company's 2027 fiscal year, a change in business climate related to competitors' innovative products indicated to management that the $170 million book value, which was the cost of $300 million less cumulative depreciation of $130 million. So the $170 million book value of the assets of one of Dakota's factories may not be recoverable. Management is able to identify the cash flows from this factory and estimates that the future cash flows over the remaining useful life of the factory will be $150 million. The fair value of the factory's assets is not readily available, but is estimated to be $135 million. So let's look at step 1, which is, do we have an impairment issue? And step 1 is we're going to look at the book value of the asset, and which is the cost minus accumulated depreciation, which we're told is $170 million. And if the book value is greater than the undiscounted future cash flows, which we're told here is $150 million, then impairment exists. We haven't calculated yet how much that impairment is. So this is saying the same thing if your estimated undiscounted future cash flow is greater than, is less than your book value, then impairment. This was just the way it was written out in the in this recoverability test slide. So I just kind of want to rewrite it the way you saw it originally, but it's the same thing. So now we say, okay, yes, an impairment exists, is warranted. So how much, now we have to measure the impairment loss. And the measurement of the impairment loss is going to be the book value less the fair value equals the loss, the impairment loss. So let's look at, it tells us the book value is, we have a cost of 300 million and accumulated depreciation of 130. So the book value is 170 million. And then we have to see what's the fair value. So it tells us that the fair value of the factory's assets not readily available, but estimated to be $135 million. So we're going to take that fair value minus the book value, and or book value less fair value is a loss. So in this situation, the loss is 35 million. I want to point out again that this fair value for the measurement for step 2, don't confuse it with this $150 million. That $150 million is the estimated cash flows over the remaining useful life. It is assumed to be the undiscounted, because if it was discounted, it would tell you such. Okay, so now we have a impairment loss of $35 million that we need to record. This is a lot of arrows here, but we have the loss, so we're going to debit loss and impairment for $35 million. And we have our accumulated depreciation for $130 million, we're told. So that's typically normally a credit balance. So we're going to just write that all off. We're going to debit accumulated depreciation. And now, when we look at our factory assets, which is what this is, our original cost is 300 million, right? The fair value, we're told, let's just erase some of these things. We're told that the fair value is $135 million. So that's what we needed to be on our books for. So right now we have a cost of 300, we need to be 135. So therefore we're going to credit the factory assets by $165 million. Okay, now let's talk quickly about indefinite life intangible assets other than goodwill. And those could be trade names and trademarks. Those are acquired trade names or trademarks. We're going to be talking about impairment of goodwill in a different video. But all other indefinite life intangible assets also have to be tested for impairments to see if the value that they're recorded on our balance sheet is currently matches the future benefit that we're going to receive from those assets. And indefinite life intangible assets are tested, testing for impairments is done annually, or it can be done more than once a year if the events or changes in circumstance indicate that that's needed. Versus the assets we've been talking about up to this point, the property, plant, equipment, and finite life intangible assets, we only test for impairment when an event has happened that might trigger that testing. So the indefinite, the changes that it's done annually for sure, and more frequently if needed. And if the fair value of the, let's just go actually to here. On the other assets we had, step 1 was the recoverability. recover, and step 2 was the measurement, right? In indefinite life intangibles, there is no step 1. There is no recoverability. And the reason for that is to determine if an impairment exists, we have to look at the book value compared to the estimated undiscounted future cash flows. If an asset remains for an indefinite amount of time, we can't estimate the future cash flows because presumably that asset will exist forever. So there is no recoverability test when it comes to indefinite life intangibles. We just skip over to this measurement test, and the measurement test is exactly like the previous assets, where we look at the fair value, and if the fair value is less than the book value, then then we have an impairment loss that we need to record in the exact same manner as we did for the other assets. Let's talk about disclosure notes. If an impairment loss occurs, companies need to disclose that in the notes to the financial statements, and the notes should include a description of the asset or the asset group that's been impaired, why we're impairing it, right? Like the facts and circumstances leading to the impairment, the amount of the loss if it's not separately disclosed on the face of the income statement. So when you have an impairment of goodwill, you'll have a separate line item for that. But for other impairments, you may not necessarily have a separate line item. And if that's the case, you need to disclose the loss in the notes of the financial, and you need to disclose the method you use to determine the fair value. Was it an estimate? Was it the present value of future cash flows? Right? There's different ways to determine the fair value, and that's what you need to disclose.